Right. Hello, everyone. Thank you for joining us today. My name is Michael Johnson. I'm a portfolio manager here at Boulay Wealth, and we are glad that you could join us for what should be a timely and informative conversation. We are honored to feature Kevin Gordon as our guest speaker today. Kevin is head of macro research and strategy at Schwab Center for Financial Research, and he helped shape Schwab's perspective on the economy and the markets. In his role, Kevin works closely with the firm's asset class strategists, researchers, and trading team to analyze macroeconomic trends and determine how they affect investors, then helps communicate those insights to clients in the broader market. He's a frequent guest on CNBC, Bloomberg TV, and Yahoo Finance, and is often quoted in Bloomberg and Financial Times, The Wall Street Journal, CNN, and MarketWatch. Kevin joined Schwab in 2019 as a research associate to chief investment strategist Lizanne Saunders. He holds a bachelor's degree in economics and political science from Pepperdine University and an MBA in finance and economics from New York University's Stern School of Business. Today, Kevin is going to share his perspective on what's driving the markets. There's no shortage of topics to cover, from the current economic landscape to key market trends and the factors influencing investor behavior. I will be guiding the conversation with a few questions to explore Kevin's insights and keep us focused on what matters most for investors. And before we get started, here's a plan for today's conversation. We'll begin with that moderated discussion for about 35 minutes, and we'll cover key themes together. Our remaining time together will be reserved for audience Q&A. I invite you to use the Q&A feature at the bottom of your screen to submit your questions throughout today's session. Note that is different from the chat feature. There is a separate Q&A button to select. Lastly, this webinar is being recorded, and we will share a link to the recording after the presentation is complete. With that, let's dive in and give a warm welcome to Kevin Gordon. Hi, Kevin.
Hey, Michael, how are you? Thanks for having me. It's a pleasure to be here.
Doing great. Yeah, we're very excited to have you. Well, with that, let's dive right into discussing the economy. It's been a remarkable few months. We started the year with maybe one set of expectations, then the Iran conflict changed pretty much everything. And now we're sitting here after maybe a framework deal has been announced. Walk us through how your economic outlook has evolved during this entire time frame and what this path towards potential resolution means for growth and inflation for the economy from here.
Sure. So I think if you look at the headline level, the 30,000-foot view for the economy, you could make the argument that it has largely brushed off any concern from the war. There's a few reasons for that. Mainly the fact that we came into this year with a pretty significant oil supply in terms of inventories. So that drawdown has been, yes, very severe, not just in the United States, but across the world. But that has really cushioned against the sort of major blow that you would see from oil prices. Not that oil prices and their spike haven't impacted the economy, because certainly the broader consumer has felt that. But when you kind of bubble it up to the surface of GDP and non-farm payrolls and the unemployment rate, all these big macro statistics, the economy has looked relatively resilient. Just the jobs data alone, in the past 3 months, we've created almost 600,000 jobs in the US, and the unemployment rate has been unchanged at 4.3%. That's pretty impressive when you think about the scale of the disruption of the oil shock. And now, as you mentioned, if we do get some sort of framework of an agreement and of a deal, that in and of itself is not opening the floodgates to, I think, an economic boom, and certainly not a boom for the consumer. But of course, it's a step in the right direction, assuming that all goes well in terms of less conflict, hopefully no conflict moving forward. And then from here, certainly a series of months to reopen the Strait of Hormuz fully and have ships, go through that are sort of unaffected by and not impeded by, either side. So I think that's really the key now moving forward, is seeing what does the traffic resumption look like? Because so far it's still basically zero. Are there captains who are willing to get on ships and willing to sail through? Are those ships insured? Has Iran cleared all the mines in the strait? So there's a lot of unanswered questions that come along with this, and we'll get hopefully more on Friday when this agreement is supposed to be signed. But I would think about the economy in sort of two different speeds. There's the speed that I mentioned in terms of the broader macro, but there's also a lot more pressure on the consumer, and that has really been the weaker part of the economy. But even within that, And last point I'll make on this, there's also sort of a two-speed situation happening where if you think about the consumer in terms of income and then consumption, so what are they making, what are they spending? From an income standpoint, real wage growth has been negative for 2 months. Not surprising because of how sharply inflation has risen. But if you look at the consumption side, inflation-adjusted spending has still been positive and it's been relatively resilient. Even this morning, we got retail sales data for May, and that's reported in nominal terms, but even if you adjust it for inflation, it was still positive. So what's happening there is there's a pretty strong wealth effect at play. Certainly, when you go up the wealth and the income spectrum, people who have made a lot of money in asset markets and particularly the stock market have continued to hold the economy up. But then there's also the fact that the savings rate has come down significantly in the U.S. So even for those who are not benefiting from this asset boom, we have seen a pretty significant drawdown in savings. So I think that it is, this agreement is happening at the good time or the right time in the sense that if energy prices continue to roll over, it probably gives the broader consumer time to rebuild some of those savings and some of that cushion. So that's one of the reasons that I don't necessarily think this leads to some boom in consumption. And actually, I wouldn't be surprised if you saw a little bit of a pullback in consumption. Still positive, but I wouldn't be surprised if that growth rate slipped a little bit. So, the way we see things evolving, moving forward, as long as you still continue to see this sort of relative stability in the labor market, where job growth is net positive, the unemployment rate, doesn't tick higher, and you still have a relatively strong business capital spending cycle, mostly on the AI side. Growth can continue to look relatively solid, probably driven more by the business investment portion than the consumption portion. But that's sort of how we see things evolving for the economy for the rest of the year.
Right. Wonderful insight. You touched on labor and unemployment as a few of your supporting arguments there. Let's focus in on that unemployment rate. And if you look back several years, it has been rising steadily in small increments, but steadily rising over the past several years. That pattern historically signals a potential for a recession. What's your read and why might this cycle might be different? I'm assuming some of this that you already mentioned comes into play.
Sure. Yeah. I mean, it's pretty remarkable. I'm a big economic history nerd, so I study cycles religiously and just all day, every day. And what I find most interesting about this cycle that we've been through in the past couple of years is that if I just showed you a chart that compared the unemployment rate in terms of the length of time that it was rising, so from start to finish, from trough to peak. You would look at the increase that we've had over the past several years and you would compare that to prior cycles, and it lines up, pretty much in line with other recessions. You would say, oh my gosh, definitively we are in a recession. But if I showed you that against the magnitude of the increase, it is completely at odds with every other cycle and every other recession that we've had. So in the length of time that we've seen the unemployment rate rising, that is recessionary. But in terms of the magnitude, it's not recessionary at all. So if we have seen the peak in the unemployment rate for this cycle, which is, I would say the odds are probably better that we have. But that would be definitively the most unique labor cycle that we've seen in this country because it hasn't happened at the broad level. You haven't seen these mass layoffs that typically give you that domino effect of consumers pulling back on spending because they've been laid off, business revenue then getting hurt, and then that causes sort of that feedback loop that tends to result in a recession. It hasn't happened that way this time. We've gone through a series of rolling recessions in the US, which frankly started back in the 2022 to 2023 timeframe when manufacturing was first falling into a recession. Then it sort of spread into, the other areas that are thought of as kind of white collar, professional and business services and financial services and tech. Those areas are now getting hit more on the labor side as manufacturing starts to recover a little bit, and you have these other areas like health and education services, which continue to be just these amazing job creators. So all of that is sort of happening under the surface as the broader unemployment rate has kind of crested, stabilized a bit, moved largely sideways, over the past several months, which again is this unique phenomenon that we've never really dealt with before. So I think it makes sense given how unique the cycle has been post-pandemic, but it also has created a lot of this confusion over, where are we in the cycle? Is it the case that because the unemployment rate has seemingly peaked, does that mean it's about to move lower, and then maybe that becomes an inflationary problem? All of that sort of remains to be seen, and I think that is kind of one of the bigger problems that confronts the Fed, because if you do have the labor market that starts to retighten a little bit, or at least show signs of that, then you potentially have an issue from a monetary policy perspective where they have to entertain the idea of rate hikes. And they've already shifted in a relatively hawkish position. We'll get a lot more answers today after the Fed meeting and the press conference from the new chair. But I think that's a dynamic to keep in mind is the fact that because this is such a unique cycle, we don't really have a lot of comparisons or comps, historical comps for something like the unemployment rate and also something like inflation. Because you're seeing a lot of inflation being generated from what's going on in the AI space. The missing component has been that wage-related labor inflation. So that is kind of to me, that's actually the key for the rest of the year is how much does that come back online, if at all, if you do see a retightening of the labor market and if labor demand starts to come back strongly.
Yeah, very interesting. Maybe another piece of the inflation conversation that has been lost for several months, given everything going on, is the question related to tariffs. Where do we stand in terms of what the tariffs have done? Have they hit the economy? What's already baked in, and maybe what's still uncertain as it relates to tariffs and its relationship to inflation?
Yeah, so I think if you looked at it in terms of growth and inflation, growth, the tariffs have largely had no major impact on U.S. growth. You could make the case that we had that slowdown in GDP last year, not that it went negative, but slow down into the fourth quarter. Some of that was actually more so too to the government shutdown that we had and that record government shutdown that we had. So that kind of created this almost a little bit of a mirage of what was going on in the economy. So I think from a growth perspective, the tariff impact is behind us. Even from an inflation perspective, if you were looking at CPI on a year-over-year basis, which is how most people on Wall Street tend to think about it, the goods component of CPI and the core goods component, so taking out energy. That has probably seen its peak for the cycle. I'm assuming you don't get another huge slate of tariff announcements, which you can never be too sure these days because you really never know in terms of policy. But if that is the case, even as the administration kind of starts to rebuild the tariff wall a bit with these other avenues, Section 122 or 301 or 338, whatever route they go down, assuming we get that rebuilding of the tariff wall, not one for one, but if it goes back up and you see the effective tariff rate go back up, you probably still have some tariff-related inflation pressure for the goods portion of inflation, but I don't know if it gets us back to the peak that we saw last year. So that full pass-through for tariffs is probably behind us. So the peak impulse, I would say, to the upside is behind us, which is good news for year-over-year inflation. Not so good news for that lingering inflationary pressure that is still with us, in the goods portion of CPI. So all made more, I think, more difficult by the fact that number one, we've had this energy shock, earlier this year, so that's put upward pressure on headline inflation. But number two, and I think this is a much kind of bigger part of the discussion, and it's going to be a bigger part of the discussion for inflation, assuming energy now starts to roll over. You do have this AI-related sort of demand surge that's happening, in these key areas, software, hardware with computers and equipment, things that are related to anything infrastructure in terms of power and utilities. That is all now starting to look pretty hot within the inflation data. So you have that along with potential for some, little heat in some reheating of the tariff-related inflation, and that's sort of creating again a difficult backdrop for the Fed. So I don't really see the tariff outlook changing in terms of us living in this higher tariff world. But we have to. I think it's also worth keeping in mind that we're sort of past that peak impulse in terms of tariffs. Major upward pressure on inflation and that big boost that we saw last year.
Right. That makes sense. We've touched on the Fed and maybe their thoughts on what they might communicate throughout the rest of the year here. But let's shift gears to talking about Treasury yields more broadly. They've been very volatile all year. First, obviously spiking with the war-driven inflation fears and the Strait of Hormuz, and then falling and pulling back as oil fell. And now we have the deal news as well. Where do you see yields settling from here, and what does that mean for equity markets as well?
Yeah, so our fixed income team is pretty much in the camp, assuming you don't get any major recessionary dynamic that emerges where it would pull yields lower, and assuming you don't get any major inflation impulse again, again barring another supply shock, which we can never be too certain these days. But keeping those two factors in mind, you probably have 10-year yields that are range bound for the rest of the year. So our fixed income team doesn't see a whole lot of movement there. And I think, that makes sense from where the economy, from the standpoint of where the economy is. I talked about growth looking relatively solid. we're not necessarily in this GDP boom. And I think one way to think about that is even though it's being driven by all this business investment and especially within the AI space, you have to keep in mind that because you're going through this massive sort of boom in imports, because a lot of that equipment is imported, imports are counted as a subtraction in the GDP data. So it's not a perfect one-to-one offset, but the more that these businesses import things for that AI spending cycle, the more the import actually goes up and that portion of GDP starts to subtract from growth. So I think that's one reason that the bond market has sort of been responding to this in a somewhat rational way, I think, because we're not necessarily going through this boom and inflation is still an issue. So for the most part, yields have been rising, when inflation becomes a problem and then vice versa. And in terms of the relation to the stock market, I think that means that yields will continue to be a key driver of the market's moves for the rest of the year. And you can kind of think about that in terms of the relationship and the correlation between those two being negative. So if you look at 10-year yields and you look at something like the S&P 500, we look at this sort of on a rolling 30-day or a rolling 60-day basis, but just think about it over the past few months. We've gone now into this territory where that relationship is negative. So all else equal, every time you're getting a significant increase in treasury yields, you're getting a down day for stocks and then vice versa. That is consistent with the market telling you that inflation is more of an issue and not growth. That's not, an awful environment to be in, but it also means that on days when you get, let's say a jobs report that looks inflationary, if that's putting upward pressure on bond yields, then you're probably getting a negative reaction in the stock market. So it's just a little bit different than what we had been used to. Certainly, in the cycle leading up to the pandemic, where every time yields were going up, it was because the bond market was saying, "Hey, growth is looking good and looking solid," and then vice versa. That's not the case today. So I think that we'll remain in this sort of inflationary environment, or at least an environment where the market is more focused on inflation than it is on growth.
Absolutely, totally agree. Thinking about other safe haven assets aside from treasuries, maybe like gold, um, also been volatile through the Iran
Oh yeah.
conflict and leading up to it. What does that tell us about how investors should be thinking about traditional diversification? You touched on how this cycle is certainly acting differently than pre-pandemic cycles. What are your thoughts on that?
Yeah, gold, it's so funny. Gold is this quite literally this shiny object that people always kind of gravitate towards rightly so, when it's moving in extreme ways. So earlier this year, when it was having just some of those parabolic moves, and every single news story on my Bloomberg terminal was related to gold. We were getting the question a lot actually, especially when everything was happening with Venezuela and when everything was potentially happening with Greenland, which I can't believe was still this year. But when all of that was going down, there were questions that we were getting from investors and from clients, and sometimes from the media, saying, how are markets not reacting to this? And they were mainly thinking about it in the context of the equity market. But our response would be, no, they are reacting to it. It's just happening in the precious metal space, and that's where investors seem to be flocking to for safety and for a potential haven. And I think that makes a lot of sense when you think about the reaction function for investors in this post-pandemic world. Other asset classes, not just stocks and bonds, have really been, they've sort of come alive again, whether it's in the commodity space, whether it's in precious metals specifically, whether it's even in, energy specifically, if you're kind of, dissecting the commodity complex. Those have kind of reawakened again. And I think that some of those trades within precious metals are sort of indicative of a lot of that geopolitical stress that people have felt, mostly because when you look at, the equity market's fundamentals for this year, we came into the year with a relatively, solid outlook for earnings estimates for the S&P. So it's not as if a lot of those geopolitical issues completely changed the profit outlook for the market. So I think it makes a lot of sense as to why there wasn't a lot of selling pressure within, U.S. stocks, as an example, and why you saw a lot more upward pressure in something like metals. So whether that continues to be, the case, I think unfortunately, we'll only find that out if we get another kind of geopolitical supply shock. But I think that it's sort of indicative of where kind of sentiment has how sentiment has sort of evolved in this cycle. That's not only showing up in the stock market, it's showing up in these other areas like metals.
Absolutely. Well, thank you. We've covered a lot of ground on the macro or economy side, growth, labor, tariffs, the Fed, yields, and so on. Let's maybe zoom out and ask how investors should be thinking about all of this, putting it all together. We've touched on it. We've lived through the pandemic, zero rates, rapid rate hikes, inflation, war-driven inflation, all within the last 5 years. It's crazy to think about. What's the most important mindset shift you'd ask investors to make to navigate this kind of environment going forward?
Well, I certainly think that the volatility backdrop has changed for the equity market. And I'll preface this, much to my comments or similar to my comments about the bond market. I don't necessarily think this is an outright bad thing. I think this is just the different nature of markets that we kind of have to get used to. But the fact that a smaller share of companies in the S&P 500 or the Nasdaq, pick whatever index, large cap index you want to pick. The fact that you do continue to see this concentration issue, and it does get worse in the sense that a smaller share of companies, constitute a larger share of the index's market cap. Um, that just means that all else equal, you're increasingly at the mercy. If you're an index-oriented investor, you're increasingly at the mercy of these names. So the 10 largest names in the S&P 500 accounting for 42% of market cap. That means that close to a half of the move on any given day is going to be attributed to those names, assuming they're moving in an extreme direction. And we've been having a sort of a clustering of these days, which I just call opposite days, where there could be one thing happening at the index level. So the S&P 500 could be up. But then when you look at the number of members, the net number of members that are advancing, it could actually be negative. So you've got more stocks that are falling, but the index is doing better. That's really just the story of, okay, big tech or the big AI names are doing well, vice versa. And actually earlier this year when the index was kind of struggling and was sort of flat for the first month or so, we were actually relatively constructive on that because under the surface, the average stock was doing pretty well. So in terms, you could think about it in terms of the equal weighted S&P 500 was doing well, the cap weighted S&P 500 was not because US tech was underperforming and it was sort of going through this de-risking phase. So I think that is becoming the new norm. Maybe it's kind of the ultimate duh statement, but this sort of goes to, I think, for investors out there who are index oriented. I think it speaks to the idea and the power of knowing what you own. If you're in something that is, akin to a cap weighted index like the S&P 500, you're going to be increasingly at the mercy of that small share of companies. So if the index is not doing well, but the average stock is, you can kind of see why because of those larger names. So it's not, I think it's not a reason to be outright bearish or outright bullish on those cap weighted indexes. It's just to sort of think about how things have changed over the past several years. And it's been a phenomenon that's been happening, frankly, for the past decade. It started with FANG and then it moved into Mag 7. Now it's some form of the Mag 10 or whatever you want to call it.
Right.
But that I think, in terms of your approach to markets as an investor, and especially a cap weighted index, I think that's going to increasingly matter.
Absolutely. Well, shifting to markets more specifically, we've covered it, another interesting first half of the year. Maybe shifting back to the topic of Iran as it relates to markets specifically. They sold off hard when the conflict began, then recovered slightly as the ceasefire rumors or news took hold. And now we're seeing another leg up the last few days or weeks leading up to the deal announcement. How do you think about what's actually been priced in versus what's sentiment-driven reactions at this point? What are the risks to the optimism that we see if the 60-day negotiations that are happening right now tend to potentially fall through or stumble?
Yeah, so I mean, I think the somewhat obvious risk for the negotiations falling apart is if that happens and if you get a resumption of the conflict to some extent, you do run the risk of oil prices shooting higher again and then rates moving back up. And, that would be consistent, I think, with downward pressure on the equity market. What's harder, though, I think, to decipher in terms of the market's response to this is that there's another kind of aspect at play, or there's sort of another theme at play in terms of, just massive volatility within the semiconductor space and at times within the software space. Both are sometimes at odds with each other. Those are the biggest components of US tech. US tech is the biggest sector in the S&P 500, so that's driving a good portion of the moves. So sometimes it's actually a little bit harder to sort of glean what the signal is coming, is from the market, especially as this is such a big IPO year and you do have, some evidence of at least the retail cohort and the retail investor that has been sort of de-risking and maybe freeing up capital if they want to participate or not. We never know that for sure because it's not like they answer a question every time they sell and say, this is exactly why I'm doing this. But that could be a factor, in this backdrop. backdrop. So I think broadly, yeah, I think it would be a negative for the market if you do get, sort of the can kicked down the road for this deal. But I think that taking a step back and looking at the fundamental picture, the profit outlook, as I mentioned earlier, has only gotten stronger this year. And if you look at earnings estimates for the S&P 500, they've gone up for every single quarter, and they've gone up pretty aggressively. There is a good and a bad to that. I think the good is, of course, that companies have consistently beat estimates and have surprised analysts, surprising them to the upside, not just at the profit level, but also in terms of guidance. But the negative of that is, of course, you continually raise the bar. So the bar has now gotten very high for the rest of the year. So to the extent that you've got a company that maybe misses estimates a bit, or for the hyperscalers, if the CapEx budgets widen out even more and that spooks some investors in terms of, not having as much free cash flow and sort of drying up that portion, that portion for that portion of companies, that I think brings you more to that corrective risk, which we've had, over the past couple of years. Every now and then you go through an earnings season, where the hyperscalers and the mega caps come out with these budgets and investors get nervous. It sends that group into a correction, causes a sort of a broader stumble for the market. But I think broadly from a profit standpoint, as long as that's not affected, the corrections remain corrections. They don't turn into bear markets. So I
Sure.
think that's sort of an aspect to keep in mind, especially because, these days it feels that it's no longer earnings season. It feels like CapEx season because I think that's the number that most people are focused on for these companies. I'm not, a believer in that. Of course, I think we should always be looking at earnings, especially for the rest of the market. But that has become a focal point for earnings season is specifically that CapEx data.
Right. Well, earnings, as you just mentioned, have been sort of an anchor given earnings reports that we have had this year. But investor sentiment has kind of been all over the place. What do those sentiment swings earlier in this year tell us about where we are in the market cycle? You mentioned you're a cycle historian. What typically happens next when we see these sort of sentiment swings?
Yeah, this is another one where it's harder to do historical comps because at this moment, we are seeing a really interesting spread between, behavioral sentiment and attitudinal sentiment. So behavioral is what people are actually doing with their money. It's flows into ETFs or single stocks or, options positioning, just broader equity positioning, all that stuff that we look at on a daily basis. But then you have the attitudinal side, which is, survey based. So it's asking people, are you bullish? Are you bearish? How do you feel about the market? Are you anxious? It's the anecdotes I get when I go out on the road and speak with clients. And the attitudinal side has actually been relatively bearish and relatively skeptical. So it's sort of at odds with the bullish, all of the bullish and somewhat euphoric, data points that are coming on the behavioral side, whether it's household exposure to stocks, as a percentage of financial assets, which is at an all-time high. If you looked at stocks as a percentage of household net worth, that's at an all-time high. We've crossed the Rubicon of stocks now having a larger share in net worth versus real estate in the U.S. You look at fund flows, and they are incredibly strong, definitely skewed by the tech sector. So all of that is still at odds with the attitudinal component that is still, relatively skeptical. So it's typically not until you get both of those in the same camp, whether it's euphoric, whether it's, depression, where you kind of sniff out some of these turning points in the market. So I think that you would need to see that attitudinal component catch back up.
Sure.
And for us to kind of get into that, what we call that silly territory for the market to kind of start to look vulnerable. That doesn't mean that you can't have, pullbacks along the way. We've certainly experienced that, earlier in June. But I think that in terms of a bigger kind of red flashing warning, bear market warning, you would need to see that attitudinal component pick back up.
Right. That makes sense. We've touched on it around the fringes here, but focusing on sector and style leadership, we have seen some broadening beyond the Mag 7 or Mag 10 now, whatever it is. Do we see that as being durable in today's environment, or do you anticipate that concentrated leadership that we've seen come back to life?
Yeah, I think as long as the economy remains on its trajectory and you don't have a Fed that turns, excessively hawkish or aggressively hawkish, which right now, I don't think that's necessarily the case. I do think that there is a case to be made for that continued broadening. And actually, a lot of people don't realize this because there's been so much focus on semiconductor and tech outperformance in the past few months, since the March low. But year to date, Russell 2000 value is outperforming the Nasdaq and the S&P 500. The Russell 2000 broadly is outperforming the S&P 500. So small caps have actually held on, and they're poised for continued outperformance for the first time in a long time. And a lot of that is driven by the fact that their earnings profiles have changed. If you look at forward earnings estimates for the S&P 600, which is the small cap version from S&P, we like that one because it has a profitability filter, so it's easier
Right.
to look at the earnings data and the PE data. So if you look at the fundamental profile for that index, it's actually shifted dramatically in the past 6 months. I think some of that is driven by maybe a lagged effect from monetary policy and what has been done by the Fed from 2024 to the end of 25, but also the fact that small cap America went through a pretty aggressive cost cutting cycle last year in terms of labor. So they've shed a lot of cost. Was obviously
Sure.
wasn't great for the labor market, but if you think about the bottom line, having improved for those companies, now the trajectory has improved. So I think that if you do get a pickup in job growth, if you get some of this geopolitical uncertainty that does, sort of start to go back out, and that tide goes back out, then I think that that's largely beneficial for that broadening trade. It's hard because this never happens in a linear fashion.
Right.
This actually started back in October of last year. Of course, it was disrupted in a major way in late February when we had the onset of the war. But you look at international markets, you sort of loop them into this broader trade or the broadening trade, and they've done relatively well. Some of them are still outperforming the S&P year to date. So I still think that that's a viable way to think about diversifying within the equity market. But you just have to be comfortable with the fact that number one, it's not linear. Number two, it's not the case that it's going to happen, sort of year to year. So you can have
Mhm.
this turn in performance of international versus the US, but that doesn't mean that every single year in that cycle, it's going to happen that way and it's going to unfold that way. There's definitely frustrating moments that come, throughout that time.
Right. Moving back to be specific on the Mag 7 again, for years now, conversation around valuations has been top of mind for investors, asset managers, and so on as it relates to the valuations of that specific segment of the market. I heard you speak on a podcast recently, and you provided perspective on how you view those equity valuations today in the context of today's economy and today's market and how they might be inaccurately compared to the market and economy of previous decades. Could you share those thoughts with us today?
Yeah, sure. Yeah, I think it was on maybe my friend Michael Kantrowitz's podcast. He's from Piper Sandler. He leads investment strategy there, and he and I have kind of traded notes back and forth on this over time, where you do have to look at, I think, the construct of the market and how it has changed, and specifically sort of the sector makeup and the fact that over time we have become increasingly a tech dominated and a services oriented economy. So if you think back 50, 60 years ago, at points, we had these really stretched valuations, similar to what we had, today in these kind of prior bubble periods, whether it was the Nifty 50, whether you actually bring it up to, the late 90s and the early 2000s. The market looks expensive across virtually every metric. Trailing PE, forward PE, Tobin's Q, the Fed model, pick your metric. It looks pretty expensive. But because we've become more tech dominant over time, it's sort of justified, higher valuations. And you can say that and have this sort of backward looking data, and you can look since, the early 2000s when we started to go through that shift. We've been in this more elevated and a higher floor environment for something like a PE ratio. So it's not to say that it won't ever be an issue,
Mhm.
but we always like to say, Lizanne and I like to say that price to earnings, that is really just a function of investor sentiment, and it's just what people are willing to pay. Sometimes they're willing to pay very high prices for for
Mhm.
for earnings, and we are in that environment. We've been in it for a while. Sometimes they're not willing to pay anything at all. That's the March 2009 low. That's the March 2020 low. That's the October of '02 low. Those are the times when nobody is willing to pay anything, no matter how far valuations fall. So I think because of that evolution of the economy and the fact that we have become more services based, import based, tech dominant, that has to some effect and to some degree, justified higher valuations. But that doesn't mean that it doesn't carry risk. I mean, of course, when you get into that that sort of higher atmosphere and territory, sometimes that is consistent with, sharper reactions and drawdowns in the short term. But at the same time, and this is the last thing I'll say, we're big believers that, and this is what the data show, but we always sort of emphasize this point that valuation is a horrible market timing tool, if a good one even exists. But you look at a historical relationship between where the PE is now and what the market's performance is a year later, and all of the dots just look like they're, it looks like a Jackson
Right.
Pollock painting, and they're scattered all over the screen. So there's no perfect relationship. There is
Mhm.
no, okay, a starting PE of this means the market's going to do this next year. That doesn't hold. So I would never use it. I would encourage investors to never really think about it in terms of performance. You sort of have to think about it and how what your risk tolerance is and how it sort of fits into your portfolio in terms of valuation and the risk factor that that company or that industry carries.
Right. Switching to maybe a little bit of a portfolio management conversation. One area where our investment planning discussions often lead is to how to think about diversifying a portfolio. How do you think about the role of real assets specifically, or maybe alternative strategies in a portfolio, especially when traditional stock and bond correlations break down?
Yeah, I mean, I do think because of that, that point that you mentioned, it certainly has pushed a lot of investors, in the conversations I have, it certainly nudged a lot of investors into thinking about that as a, sort of as a viable alternative, no pun intended. But I do think that that has become a bigger part of the conversation because, when you think about the volatility in the equity market alone, that has spooked a lot of investors, especially because of the concentration issue. And then you even move to the bond market and the fact that inflation is still an issue. The bond market has been sort of struggling in, price performance terms for several years now, even though you can get a relatively great yield, which we're still, we still have a favorable sort of outlook on, at least in the middle part of the curve. I think both of those factors have nudged investors into the, into the private world, into the alternative world, into the commodity world. But some of those areas, in terms of the limits that you have and what you can invest, and being an accredited investor and all of that, that of course limits certain groups of investors. And everybody's going to have a different risk profile and risk tolerance. But I do see that becoming a bigger part of the story, especially because now you have markets that are being created and that are cropping up, and new markets that are popping up all the time. I mean, crypto is still relatively young and it still
Mhm.
has so much interest. So I think that's just another example, and why kind of some of these traditional asset classes, because of the volatility that we've had, it's not that people are moving out of them wholesale in any way, but I
Right.
think it's sort of forcing them to broaden their horizons, and I think that'll continue to be the case.
Mhm. Absolutely. Well, thank you. That wraps up my portion of the moderated discussion here. Thank you, Kevin, for your
Yeah.
insights. Let's turn to audience questions. If you've already submitted a question, thank you. You still have time to submit your question. So as a reminder, you can use the Q&A button at the bottom of your screen. That is different from the chat box. Please use the Q&A button, and you can type your question in there, and I'll be pulling those together for Kevin. So let's start off with this question here. As we think about, one of our audience members asked, as we think about large companies such as Meta and Goldman Sachs proudly claiming increased earnings from cutting human jobs in favor of AI, as well as the dire predictions for the labor market coming from the AI companies themselves, how do you see this fast emerging technology impacting people at or near the beginning of their careers? And what are some realistic solutions?
Sure. That's a great question because it actually hints at, I think, the how I think, well, number one, how the AI impact has played out so far, but also number two, how I think it'll probably continue to play out. So at the broad macro level, it has not been this net job destroyer, and I don't think it will be. I mean, I'm an optimist when it comes to technological revolutions, not just because after every single one we've seen net job creation, but because I think that it sort of creates, new opportunities, and it creates new industries, and I think it'll be no different this time. But that question specifically pointed out two industries, being financial services and tech, that have actually been really the poster children for job cuts due to AI. So if you look at those two industries, they are the only two, broad industries that have actually shed jobs over the past year. And tech actually has been it's been much more severe. So tech employment in the US peaked in November of 2022. maybe not coincidentally, that was the release of ChatGPT. So since then, it's just been this steady decline, which has been, pretty horrific for tech employment. I mean, there's no way around it. I don't want to sugarcoat it. Financial services has been struggling over the past year, but outside of those two, you have not seen these sort of broad-based impacts to labor. And if you looked at total non-farm payrolls, they are at an all-time high. We're making up for the cuts in tech and financial services and other areas of the economy. So when I talked about that, white collar recession, hiring recession earlier, that still is the case. But it's just it's more concentrated in terms of which industries are affected. So this is not to say that there's nothing to worry about in terms of AI's, impact on labor. But will it have to, I think, cause some people to readjust their thinking, in terms of younger people assessing their career path and what opportunities exist? I do think so, and that seems to be the path that we're on. I do think the good news is, though, again, when you look at this at the high level, there hasn't been a whole lot of disruption in terms of the number of people that have to switch jobs on, from month to month. That's a metric that I like to look at because it kind of shows the friction in the labor market and whether there is a lot of disruption going on and excessive disruption. And when you compare this current environment, and since in the current AI boom, relative to the creation of the internet or the creation of the computer, it doesn't look dramatically different versus those two eras where you're seeing this, huge increase in the number of people who are having to do those job switches. That would be more worrisome to me. But so far the data haven't shown that. And, last thing I'll say is I do think that there's going to be more of a premium put on kind of the in-person and human interaction and human touch. The law of supply and demand is such that when you have more supply, prices tend to sort of go lower, the premium tends to go down on that. And we kind of have oversupplied the digital space. We're flooded with all of this stuff now in the digital in digitalization. So I think ironically that kind of puts back the premium on things that are not digital. That's not going to be this, perfect scenario and one to one. We go back to, everything being in person because I think AI, is certainly here to stay. But if there's an optimistic take on that, hopefully, people feel the same way I do. But I think that would be the optimistic take on how things shift for the labor market.
Awesome. We have another audience member here looking for your thoughts around international markets, probably in light of the geopolitical conflicts and issues that we've seen over the last several years, and along with performance we've seen this year. So maybe just a broad overview of your current thoughts on international markets.
Yeah, sure. I think it depends, certainly depends on which region you're talking about. I mean, I think you could have grouped Europe and Asia together during the height of the conflict, especially in the energy shortage, in terms of what was happening with energy shortages. I mean, those economies, excuse me, were poised to struggle, much more. So hopefully, this agreement stays in place and you can actually see oil supply come back online. I think that if you were to kind of parse those two, separate those two and look at, Europe in particular, there still has been a fair amount of stimulus over the past year put into the broader, euro area. Of course, a lot of that was sort of offset by what happened with energy prices and what's going on with inflation in Europe. But I still do believe that that is a recovery that is delayed and not completely derailed. So to the extent that the equity market over there responds to that, or that equity markets over there respond to that, I still think that gives you a relatively solid backdrop. I just think that a lot of that is going to be, still delayed, and you probably have, to lengthen your time horizon in terms of what you can expect from European markets. But I don't think that. I think that certainly, assuming oil prices continue to move lower, hopefully that keeps the ECB's rate hiking cycle pretty short. I don't know if it's one and done, probably not, but they have hiked rates. Hopefully they don't continue to hike into an economic slowdown. So I think that keeps them hopefully on the better side of things. For Asia, I mean, it's such a big region, but I think the one thing I would say to keep in mind is that, some of this volatility we talk about that's related to the AI trade, some of it is actually more extreme in certain parts of Asia. And I use Korea as an example. We talk about the 10 largest stocks in the S&P 500 being 41% of the index. In Korea, Samsung and SK Hynix, which are the two largest companies in the Korean stock market, they make up 47% of that market's of that index's market cap, of the Kospi's market cap. So you've got extreme concentration in just a couple of names that are kind of determining, half the market's move on any given day. So to the extent you're kind of looking outside of the US, if you want diversification outside of AI or outside of the hyperscalers, keep in mind that some of these countries have significant exposure, if not more, to those names. So I would think about that, especially in terms of the volatility aspect of a portfolio.
Right. Thank you for that. We do still have a few more minutes for questions. So if you do have a question you'd like answered, please put that in on the Q&A box at the bottom of your screen. Uh, let's move forward here. You touched on volatility slightly there. Just broadly, do you think this kind of volatility that we've seen this year is here to stay, for lack of a better way to say it? Yeah, what are your thoughts on volatility today?
Yeah, I think so. To the discussion we were having around that mega cap trade and the fact that, semiconductors in particular have been such a significant driver of volatility at the headline level. Yes, I do think that's probably here to stay. And I think, one way to think about, I should have mentioned this earlier, because it's sort of helpful to think about it in terms of the statistics behind it, but or the metrics behind it. But we continue to get questions around sort of the largest companies of the Mag 7, being the best performers. And that just hasn't necessarily been the case. Certainly not last year, certainly not this year. And just to kind of think about it in market cap terms, when you look at indexes and how they're measuring performance, there's the price performance component, of course, but then there's also the market, the individual stocks contribution and the members' contribution to that index, because you're factoring in then the market cap. And if you use Nvidia as an example, I'm not an individual stock analyst, so this is not a recommendation. But if you look at Nvidia as an example, it's one of the biggest contributors to the S&P 500's gain so far this year. It's about, it's ranked about seventh or eighth place, depending on which day, you look at over the past week. But its price performance, there's about 170 companies and change that are outperforming Nvidia year to date. So it kind of hits at that and emphasizes, I think, that aspect of the fact that just because they're the biggest companies does not mean they're the best performers. So, this is very much in line with the fact that small caps have done well this year, that the average stock has continued to do well. And I think that's a way to think about how the volatility environment is certainly here to stay, the one we've been experiencing, but how you can maybe draw some benefits from that. And that's not necessarily a bad thing for a portfolio.
Sure. As we look at, this is a question from an audience member. As we look at the sectors of the S&P 500, what sectors may be undervalued in today's environment, or maybe said a different way, based on today's market environment, what sectors present the best opportunity moving forward?
Yeah, so well, I'll put a plug for. I mean, we have Schwab Sector Views, which are free to, you're free to look at online. If you just type that in on any, search engine, it'll take you right to the page. And we've got a sort of a news scale that we rate them, from least favorable to most favorable. I actually kind of like to think of our current ratings and our favorability ratings as almost this barbell approach on AI. So we've got everything from, the hyperscaler communication services end of things, which we do have a favorable view on, which we think will continue to be central to the build out, and sort of this cultivation phase for AI. And then you kind of look on the opposite end in terms of the adoption of AI and who's going to benefit from that. And we have a favorable rating on healthcare, because there's a lot of industries that stand to benefit from technology, whether it's through efficiency gains, whether it's through sort of managing, cost pressures over time. Earnings for healthcare don't tend to grow as fast, relative to the rest of the market. So we do think that there's a lot of benefits there. And then if you kind of look at the kind of early stage part of this, in terms of industrials and materials, those parts of the market that are very central to, even creating the space and having the materials for the build out of some of this infrastructure, we've got favorability ratings on those two sectors as well. So everything from materials, industrials to, communication services to healthcare, that kind of gives you that broad spectrum right now of how we see, the AI trade not necessarily benefiting only a small share of hyperscalers, but, benefiting, broad swaths of the market.
Absolutely. Another audience member question. Do you think investors who've been reluctant to invest in crypto should be thinking about taking a position in a crypto ETF or exchange traded product? Maybe said a different way as well, and maybe helpful for everyone is, you mentioned crypto is young in its life cycle here. Maybe provide some insight on your thoughts or Schwab's thoughts on where you see crypto being integrated and more widely adopted.
Yeah, well, I it's a great chance to put a plug for my new colleague Jim Ferrioli. He's our new crypto strategist, which I was so glad when we hired him because crypto is its own world, and
Mhm.
I am not the crypto expert. I don't pretend to be. I don't play one on TV, but he's got great stuff. So if you just and if you don't remember how to spell his name, I'll actually just say go to the schwab.com/learn page, and all of his research and his writing lives on there along with ours. But Jim has a great way of kind of thinking about crypto sort of structurally and not just, Bitcoin and a price target for Bitcoin. That's really
Mhm.
not what we do. But thinking about all of the options that are available, what crypto bear markets and bull markets tend to look like. The fact that, on average, a Bitcoin bear market is going to be 3 to 4 times the magnitude of one in the S&P 500. So, 10% drawdown in the S&P, equivalent to sort of 30 to 40% for Bitcoin. So he's relatively constructive on it, but I would encourage you to go to sort of some of his writings to kind of get an in-depth, more in-depth look on where things stand. But I think for crypto, for me, I look at it in sort of two buckets. I think about it in an economic sense. I think about it in a market and portfolio sense. In a market and portfolio sense, I mean, you cannot deny that it's an asset class. There's a lot of interest in it. It's grown immensely over time. Uh, are there fundamentals associated with it that are similar to equities? No, but I think in some ways you can make the case that's what makes it sort of a portfolio diversifier. I would mention though that over time, the correlation to the US stock market, and particularly US tech, has grown increasingly positive for something like Bitcoin. So it is worth keeping in mind, especially if you're going into that space and working with whoever you work with in terms of portfolio management for clients. I think that's worth keeping in mind and examining over time because it has sort of become less of a portfolio diversifier than people have originally thought. In an economic sense, I still think we're sort of in this experimentation phase where people are trying to figure out what it means to be, an economic for Bitcoin or crypto broadly to be this economic force. It hasn't really been a meaningful one up until this point. I'm not too convinced that it will be. I'm not sure that that's necessarily what it needs to be for, used for. I certainly don't think it's a replacement for the dollar unless you're, somebody who's comfortable with your currency collapsing by 80% potentially in 1 year. I don't know anybody who is. But that to me, all of those aspects of it, where it's not stable that way, it's not a unit of account, not a store of value. That sort of keeps it, I think, certainly out of the traditional definition of a currency, but I think that kind of reduces its effectiveness maybe as an economic power versus an asset class in a market, in its own market, which I think are totally separate things.
Sure. All right, maybe wrap up with one more question from the audience here. This audience member is asking, in light of the large U.S. deficit, the funding issues with Social Security, and the shifting demographics, primarily baby boomers either leaving the workforce or passing on, is there any concern for the long-term economy and potential for depression per people's cyclical predictions? If so, where would an investor go to weather that storm? Little loaded
Well, I
question
will
too.
say, we've done a lot of work on this in terms of the impact of the deficit or the debt on the economy. What is the relationship with bond yields? What's the relationship with inflation and stocks? There's not really a strong relationship in either direction, and we looked at it every angle. The change in the deficit, the change in the debt year to year, the change in the debt to GDP year to year. No matter which way you slice it, there's not a strong relationship between any of those, which is a little frustrating in and of itself because you can't really identify a particular problem. But at the same time, the real way to sort of deal with this issue, if lawmakers are not going to sort of sit down and look at, okay, do we want to raise taxes or cut spending, which at the end of the day, nobody really wants to pull those levers because there's bipartisan support for not wanting to touch those, to touch either lever. But the real way to sort of grow, to kind of chip away at it out, over time is to just grow your way out of it in terms of having the growth rate of the economy being greater than the growth rate of debt. So far, that isn't the case, but that's kind of how you get that debt to GDP down over time. So I wouldn't think of it in terms of, we got to get the debt to GDP ratio down from this percentage to this percentage in, a given year. That's not the right way to think about it, I think. It's sort of this over time, what is the change in the growth rate of both? And in terms of where to kind of be positioned in the event that it continues to get worse. Again, to those studies that I mentioned where we haven't found relationships for asset classes, I don't think that's necessarily gonna, there's no, to me, there's no right answer there. And, I don't think that's necessarily the way to think about it because number one, I think the US is still relatively well positioned in terms of our deep capital markets and the sort of significance of the dollar and the value of the dollar. People haven't really shied away from that at all. Foreigners have not shied away from that, despite a year and a half of pretty significant geopolitical volatility and policy-related volatility. We have not seen this massive net selling of net dumping of treasuries. We have not seen people move away from the dollar en masse. So that data continues to hold up and support the notion that the US is still relatively attractive. So until and if when that changes, then you start to get into, a more precarious sort of situation with the debt. But again, we're not alone. We're not alone in the debt situation around the world. So it's not like we're the only country that has this massive debt overhang. But we have the benefit, of course, of what our capital market structure looks like.
Right. Well, great. We are going to wrap things up there. Kevin, thank you so much for joining today and answering all of our questions. As we wrap up, I want to thank everyone else for joining as well. I hope you found today's conversation valuable and thought-provoking. I think what came from today's conversation is that today's market environment is being shaped by a wide range of forces, and that uncertainty is likely to remain a theme moving forward. As those conditions continue to evolve, it becomes even more important to stay focused on your plan and not let those short-term headlines or decisions drive your long-term decisions. Having a financial plan in place that ties together your investments, tax situation, and long-term goals, so everything works together as markets shift, can make a meaningful difference. That's exactly what we're here to help you do. A trusted advisor can help you stay on track and adapt as conditions change. For our clients on the call today, we're grateful for the trust that you place in us. Thank you for investing more of your time with us today. If you are not currently a Boulay client but found today's discussion helpful, we would love to connect. In the chat, now in the chat box, not the Q&A box, the chat box, you will find a link to the contact form to ask a question of our team or to set up a meeting with them. You can also reach us by phone, email, or through our website, all of which are on your screen. And finally, one last big thank you to Kevin again for joining us and sharing his time with us. We appreciate his perspective and the clarity that he brought to a complex and evolving market environment.
Thanks for
Thank you
having
all
me. I
for
appreciate it.
attending. Of course, yeah, thanks, Kevin. Thank you all for attending. We will share a recording of today's webinar shortly. Have a great rest of your day. Thank you.